With that being said, we now start with our next chapter, which is going to be around applying duration, convexity, and DV01. So naturally, this chapter will take a little bit more time than the others because we are going to run you through a very comprehensive table, which is going to set some solid foundation here. All right, so let's just start talking about it. See, it's a very comprehensive diagram that I've created for you, which talks about a very long thing. But if you understand this, this helps you not for this book, but for FMP book as well, entirely for everything, entirely, because this topic is considered to be complex because a lot of questions can be framed out of any topic. People don't understand this topic as easily because the right kind of structuring is missing. It is bonds as a concept is very interesting. So let's just first talk about it. Okay. Um, when we talked initially about that there is a curve like this where the bond prices and yields look like this, and where we said the reason that the because if there is a change in yield, if the yield increases, the bond prices decrease, and the yield decrease, the bond price increases, but they don't do it in the same direction just because realistically the curve is like this, right? Realistically the curve is like this. Now that's where the whole discussion of duration or interest rate risk comes in. Duration or interest rate risk comes in. Interest rate risk, that is where people want to understand what would be the impact of the change in yield, because we understand the change in yield is going to bring some kind of change to the prices, right? So here we want to track the sensitivity of how my yields changes and how my bond price change. Ultimately, if my interest rate changes in the market, let's say by 1% or 2%, what is going to be its underlying impact on the bond price is what we want to track. But realistically, the curve looks like this looks like a curve, but mathematically, where the price increase and price decrease also had a difference. As I'm sure you might recall, we mentioned when there is a yield increase, the bond prices decrease by a lower amount, but when the yield decrease, the bond price increase by a very high amount just because of the shape of the curve. But having said that, that is the realistic picture, but we want to tackle that mathematically. So one guy, when we started thinking, and think of it like a story, when we started to find out a way how the bond prices change, there was no way to capture on the curve part. Okay, and this capturing on the curve part was not even understood back then. So they started with, let's just think of this curve as a straight line, and believing that the yield curve increase is going to bring an equal change in the bond price increase, and if there's a yield decrease, bond price is going to decrease by the same amount. And that is where they started drawing this curve as a straight line between the bond price and yield. Bond price and yield, which they believe works fine because in real life the interest rates move hardly by a few basis points, right? They don't move from 2% to 5% suddenly, or 5% to 7%. These are not sudden shocks, except there is a macroeconomic event. But apart from that, this change is very low, and that's where they said they can live with this kind of a fact. But realistically, when they said that if there is a sudden shock in the interest rate or the changes are high, the changes in this yield, like up or down, both ways are high, they have to capture for this curvaceous portion. This is where curvaceous portion. So now think of it, you are trying to, once you have calculated it for a straight line, you're now converting it into a curve. You're now converting it into a curve to capture the actual relationship. So what is happening here, this line here, the straight line, was capturing the behavior of a duration, right? This was capturing the behavior of a duration, right? For a small change in yield, the duration number can capture everything accurately, right? Or as as close as accurate. So you don't need to use too much of a mind. But when these interest rate changes here are large enough, like let's say this case, the interest rate changes are like this. This change, this is the change that happened. Okay. This is the change from, let's elaborate it. Let's say it changed from point B to point A. So it has risen. The yield has actually risen from point B to point A. Now, if this is the kind of yield change, the sudden or a high amount of yield change that we are talking about, then think of it, my duration component being a straight line is only capturing the component till this line, right? It is missing on the point from point C onwards till A. So it is missing on that price impact from C to A, which is still mentioned as a pink highlight. Now think of it, to capture for that component, duration has to be combined with the second effect, which is called as the convexity effect, which is the convexity effect. Now think of it, duration itself is a negative concept because the bond price and yields, both of them have a negative relationship. But this convexity, if I change it here, then this is going to be positive impact. But if I change it here, let's say even here, let's say, let me talk about this, then the entire impact of realistic thing is here, but I am only capturing what part? I am only capturing the green part. I'm only capturing the green part, which is the part here, which is the part here. Again, missing on this pink part. So let me call this as ABC. I'll call it DEF. So there is, when I talk about the change in bond price, I'm missing on the EF part. And here I'm missing on the AC part. Both the parts I'm missing, which means in a way I am understating my effect. I'm understating my effect. To correct for this, for a large change in yields, effectively, when there is a large change in yield, you need to talk about or combine it with the convexity effect. Now think of it this way, the actual changes in the bond price. The changes in the bond price are going to be sum total. And when we talk about bond price, it's only the parallel bond price I'm talking about, like the parallel changes, which is more trackable, right? In real life, we hardly talk about the non-parallel version because this is hard. If you remember, let me come here back. Uh, there was one diagram. Yeah, here. So realistically, the bond price or the change in the shape of a yield curve impacts parallelly and non-parallelly. The parallel version is 70 to 80% of the real life things which happen. Now this is where we focus more academically because this is the real value. You know, non-parallel से 20 से 30% तक ही add हो रहा है. That is where butterflies and twist comes in. This is where fund managers are more interested, flattening and steepening part. But when it comes to the parallel shift in yield curve, that means it's capturing 70 to 80% of the impact, and that's where duration and convexity becomes important for them. Now, when we talk about this part alone, when we talk about this part, when we talk about this part alone, we are talking about those parallel shifts. Parallel shifts. You're not talking about the non-parallel shifts. And within parallel shifts, you're further talking about duration and convexity effects which are applicable. So think of it this way: the bond sensitivity, the change in the bond price with the interest rate changes for only parallel shifts is what we are talking about right now, which is almost attributing to the 70 to 80% of the real life changes, right? Now there could be linear approximation, which is a small changes in yield where we mention only about the duration, where we just mentions about the duration, which is this kind of an approach. You just believe the duration to be a straight line, capture that, right? And then there is a linear approximation approach, which talks about combining the convexity and the duration together for a very better result. That is where you combine duration and convexity together. Since we understand duration is a negative concept and convexity is a positive concept, that is where we have brought this point here. Now, the way you articulate on a duration is also different. You know, a lot of people, duration has been a journey throughout, you know, for people's obsessiveness to understand bond, and that what makes it even difficult to understand. There's one term called as duration. There's another one called as a dollar value basis point, and the third one is a dollar value. Now, if I say with 1% change, if 1% change in interest rate, my bond price has risen by $10. If I talk about dollar terms, that becomes the dollar value. That becomes this third part, the dollar value, where everything is talked about in terms of a value being changed. Okay, when we talk about dollar value basis point, then we talk about what is going to be the dollar amount change if there is a change of interest rate by 0.01%, which is 1 basis point, change is what we track. So the impact in dollars, if I see that the $10 or the $5 bond price has risen, like, you know, the bond price has risen or has declined by $5 just because there is a 0.01% change effectively. 0.01% change in the yields in the market. That is what dollar value basis point is all about. Dollar value is about 1% change in yield, bringing the dollar amount change. What is the percentage change with $1 change in the dollar value? When it comes to duration, when it comes to the normal term duration, which is our prime focus for this chapter itself, dollar value basis point and Dollar value is hardly going to be discussed in the book. Dollar value basis point is still important from next chapter onwards. But for this chapter, primarily we are going to focus on duration, which is duration. Now, duration has been a journey throughout. When we talk about that, think of it from, I'm coming down from the very top so that you understand the complete picture in your mind. When it comes to duration, back in 1900s, there was this guy called as Mcculloch, and he was obsessive to find out the duration. But what he ended up is his numbers were more, you know, more articulated in terms of years. His method of duration was very, very different. He said, if you are, and think of it like present value of cash flow not discounted. Present value of cash flow not discounted. He was of an opinion, if you have $5, $5, $105 here, then when are you recovering your money? 1 year, 2 year, 3 year. When are you recovering your initial investment of, let's say, $90? Initial investment was $90. So when are you recovering that? Somewhere between 2 and 3 years. And that is where his macular duration was focusing on a time period. Now, from our perspective, from FRM students' perspective, if you are given any kind of interest rates which are continuously compounded, that is where you'll have to have a macular duration. The answer is that in this case, the duration is articulated as years. So my answer would be 4 years, 5 years. Remember the case above when we talked about this one. When we talk that their duration matches the maturity, this is where we are talking specifically about maculae duration. Maculae duration. This is where everything is mentioned in terms of years. Everything is mentioned in terms of years. My duration is 5 years or 3 years in this case, and my maturity is also 3 years. That is where they talk about maculae duration. That's the first way of how they kind of uh, came about this method. Then there was an advancement in the journey. Then there was this guy called, there was another guy who improvised on the previous approach, and he formed something which is called as modified duration. He moved completely away from this concept of articulating duration in years. He said it's a number. It's a simple number. It's a unitless number. No years there, no number. Only number is going to be there, and we call it as modified duration, which is good for a normal bond, right? He said it's good for a normal bond. But when it came to the effective duration, and which was more improvised version, which was used for option embedded bonds. Option embedded bonds. I'm sure you must have heard about option embedded bonds, which are putable and callable bonds in your FMP book. So I'm not going to um, talk more about it when it comes to option embedded bond, but just a small recap of what option embedded bonds look like. There could be option embedded bonds where where the third approach of effective duration and convexity comes into picture. This can be of two types. There could be a callable bond, and a puttable bond. Puttable bond. A callable bond structure looks somewhat like this. Like I'll highlight this. It looks like this. Whereas a puttable bond structure looks like this, more curvaceous here. It is more curvaceous here. So callable bond would look like this, whereas a puttable bond would look like this. In the callable bond, a person has an option to, or the investor, whoever has issued the fixed income security, has an option to call back earlier than maturity, right? And in a puttable bond, what happens is the investor who has invested his money in the fixed income security, which is retail investor like us, who has bought the bond. So the buyer of bond, or let me call it off in maturity by issuer. I'll be more specific, by issuer, and buyer of bond can sell it back to company, to issuer, before its maturity. So if the official maturity date is, let's say, 5 years itself, if the company, let's say Reliance issues a bond for the 5 year term, okay, and before the 5 year term is over, if Reliance issues a circular in the market saying, I want to buy back those securities, and you can deposit it. That's a callable bond, right? But what happens is in terms of the different version is a puttable bond. What happens here is, as an investor, if I'm unhappy investing into Reliance bond, I can go back to them and tell them, you take your bond back, give me your money back. I have an option to sell it back to the company, right? I have an option. If I'm unhappy with that, I can go back and sell them back the bond. Whereas a callable bond, they are the ones who are initiating the transaction, saying we have a willingness to buy it back. So that's the difference between callable bond and a puttable bond. In case of a callable bond, it is the value of a puttable bond is basically the value of a normal or a straight bond plus the value of a puttable bond. You are trying, as an investor, you've paid a price to be uh, long on a put option where you can sell it back to the company. Whereas for a callable bond, it is value for a straight bond minus the value for a call option. So in this case, you are short. An investor who has bought the security is actually short, because a person can exercise his right and he'll have to submit his shares back, right? If the company calls back the share, the person will have no choice but to submit it back. So the buyer is short call, or rather buyer is, or issuer. In fact, I'll call it investor is short call. Investor here is short call, right? And here, so let me put it this way. Let me be very, very specific here so that you guys understand it for life. Okay. In this case, value for a call minus VC. This is investor is short call and issuer is long call. Issuer is long call. He can call it back anytime he wants. Whereas in this case, investor is long put. Issuer is short put. Anytime he wants, he can give it back and the company will have to buy it back mandatorily. So the issuer is short put, and that's how the option embedded bonds work. It's different from a normal bond because you have an option component. Now the complexity happens because the shape of the curve is no longer looking like this. It is different from this somewhat, right? And that is the reason we cannot use a normal approach to deal with these complex two scenarios. And that is where the concept was further evolved from modified duration into effective duration, wherein we were earlier focusing on these normal bond durations or normal bonds treatment, which can be done through Macaulay or modified. Effective set, you cannot use it. If there is an option embedded component, you cannot use a normal approach or a modified duration approach here. You will need to use the new approach, which is effective duration. Now, can effective duration be also used for normal bond? Yes. If you're given that kind of information in the question, you can very well use a normal bond. You can very well use the duration, which can be calculated using the effective duration bond method. So think of it this way: modified duration cannot be used for a option embedded bond, whereas effective duration can handle both can handle both option embedded bonds and normal bonds. Okay. Now, a parallel version of this, before I come to the formulas and everything, I just want you to be very, very comfortable with the table. So when it comes to the non-linear approximation, where we talk about convexity as such, so convexities, then think of these like a parallel version. The duration here has a parallel version here. The duration here has a parallel version here, right? Based out of similar approach, the guy who provided a Macaulay duration, sorry, not this one, my bad, is this one, Macaulay duration, not this one. So let me take this out. So this is Macaulay duration is parallel to the convexity, whereas the modified duration, this version is parallel to the modified convexity or corresponds to the convexity here. And the third version, which is the effective duration, has to work alongside the effective convexity. Effective convexity. Now, this is the real structure, but in our questions academically, convexity is more like a level playing field. Whatever information you have been given, you can use it with either of these three approaches. I would say either of the two approaches mostly, not the ear ones, right? So when you're talking about convexity, they can give you talk about one convexity figure and can plug it into effective duration, modified duration, and macular duration all. So convexity is a concept which ideally should work with corresponding things, but in the question, depending on how he has or the question has framed that information, we can use convexity with either of these to calculate for the real change in the bond price. जरूरी नहीं है कि मॉडिफाइड कॉन्वेक्सिटी के साथ सॉरी मॉडिफाइड ड्यूरेशन के साथ मैं इफेक्टिव कॉन्वेक्सिटी ना यूज कर सकूं या मॉडिफाइड ड्यूरेशन के साथ सिंपल कॉन्वेक्सिटी ना यूज कर सकूं ऐसा कोई रूल नहीं है आइडियली ऐसा होना चाहिए बट डिपेंडिंग ऑन द क्वेश्चन if he is provided us with modified duration and effective convexity go ahead and use it if he has provided you with the effective duration and modified convexity go ahead and do it use it for your calculation that's not a hard and fast right? Now we come to how do we calculate for all these things that we mentioned. But before even we come to the calculation part, let's just understand when the real formula happens for duration effect and convexity effect, which we mentioned it here, how does the real formula looks like? So the change in the bond price is going to look like minus duration because duration is always negative multiplied by change in yield multiplied by bond price. That's the first part. Plus the convexity part is a little bit tough. Half into convexity into change in yield whole square. So sorry, change in yield square into bond price. So the real thing that we have been talking about, the real thing that we have been talking about all throughout here is a concept of convexity, which we are discussing here. What kind of convexity you should choose. This C is what we have been mentioning about. And when it comes to duration, when it comes to duration, this is where we have been talking about this duration, right? So think of it this way that the real formula is this, the real जिसके लिए हम सब कुछ बना रहे हैं, that is this real formula. Change in the bond price is equal to minus duration into change in yield into bond price plus half of convexity plus let me put it this way, half of convexity into change in yield square into bond price. This is the real formula for which we are doing all this calculation. But the duration here and the convexity here, which is the real thing which is impacted here, is coming out of these approaches. There could be three versions of duration and three versions of convexity, right? The most important version for us from an exam perspective would be this, and would be this. Okay, rest of the things also I'll teach you because it's there somewhere in the book. They've mentioned about all these approaches, but what is more important, I'm just focusing on that. I'll be focusing on that a little bit more. So there is the star version, the 3-star versions that you see, modified duration, effective duration, and effective convexity is going to be more or less tested for us. I mean, it's going to be tested more elaborately. Let me call it that way. It's going to be tested more elaborately. The discussion on macular duration, convexity, and all those, the remaining part might just be very preliminary. But unless and until you understand how the concept of duration is broken down into pieces, or how the concept of convexity can be broken down to three corresponding pieces, you'll never be able to get the bond duration and the bond convexity picture right, which is very important, not just for FRM perspective, but CFA or for any other exam perspective, and also from a real life perspective as well. Okay, so when we talk about the first approach, the macular duration, let's go back to our spreadsheet to understand how do we really calculate it. Okay, so I have this example, and remember, this was where I said that I'm going to talk about the durations concepts later. But for that point of time, I was just focusing on the fact that everything is basically the duration number, macular duration number, right? Now, that's where I'm back to the same kind of thing. Okay, now let's observe this. What happens is if I take this coupon rate and if I take a present value of the cash flow, what I get is a bond value. Correct? Now, what do I have to do is I have to multiply T into W. T into W. What is times this? And what is the weight? Now I'll calculate 6.54 divided by 100. 6.11 divided by 100. So, sorry, this is what it is. Sorry. This is 6.11, E8 by E14, E7 by E14, E7 by E14, E8 by E14, 5 point. So overall, the sum of all these weights should actually be 100. So in a way, I'm just understanding the present value of cash flows impact for the 100 value that I get. What is the weight? Now I multiplied the weight into time. I multiplied the weight into time and then sum total them just like the way I've been doing it, sum of the present value of cash flow. So now I'm just summing up rather than summing up everything. Rather than summing up everything, I'm multiplying the weight into time for all the periods, and what I get out of it is basically a duration, and the duration is what? Maculae duration. Maculae duration. So you can see that the maculae duration I get is 5.767, which I'm getting directly from this method as well. 5.76. Sorry, when I get this final figure, I have to divide it as well. So let's just do it where the things are not as constant. Let's say 5% and 7%. So 5840, I get the maculae duration to be 5840. Clear? So there are two ways I can just multiply this and then 5.840 is what I get. So this is how I calculate for the maculae duration. Now to go with it, I'll just explain macular convexity alongside it. Now macular convexity or the simple convexity that we talked about, convexity, is going to be multiplied where the weight is going to be multiplied by times square, t times twice. That means if I multiply this figure with 1, multiply this figure with 2, multiply with this figure with 3, and find out the same kind of answer, which is 37.912. This is going to reflect for my convexity. This is going to reflect for my convexity. So the convexity is nothing but weight into time square. Weight into time square. And when we talk about weight, what are these weights that I'm talking about? The cash flow. The cash flow for various period divided by total cash flow. Cash flows for the period divided by total cash flow is what we have been focusing on. And this is where how you get maculae duration and maculae convexity, which you can ultimately use in this formula to get your answer. You can ultimately use in this formula to get your answer. Okay. So this is the first way. Now we talk about the second way, which is the modified duration. So the person who invented the modified duration approach, he first of all converted a method or designed a method through which he can convert the maculae duration number in years into the normal or the modified duration. So the first is a transformation technique. The first method of calculating this is more like a transformation technique, which is maculae duration divided by 1 plus y by m. M is the period. So if it's annual, it's 1. M is 1. If it's semi-annual, M is equal to 2. Quarter is M is equal to 4. So 1 plus the yield divided by M gives you the maculae duration number. Okay, that's the first method. Whereas a more independent method where he was not leading a transformation from maculae method to a modified duration number was a method which was this, which is 1 upon BV into change in bond value by the change in yield. 1 upon bond value multiplied by the change in bond value by the change in yield is the second method. Now understand this when we talked about the slope. When we talked about the slope of this, we mentioned duration is an important part of it. But the real changes, if you redesign this, this is always going to be a slope for anything is change in x-axis by the change in y-axis. Sorry, change in y by the change in axis. So that means change in bond price by the change in yield. And if we just realign this formula, change in bond price by the or change in bond value by the change in yield, what we get is the book value multiplied by the duration, right? And this is what is really giving you this slope. So a duration is not slope, but duration is a major determinant of slope, right? Okay. Now look at this formula. This is a major building block till date. So minus duration to change in yield by into bond price by change equal to bond price. So the formula is actually a re-amended form of this. Now a special case which is an addition to this is for a normal bond. They talked about perpetual bond also somewhere in the book, and that's where I've noted it down, though it has not been tested. So I know the value for a perpetual bond is equal to C by Y or PMT by Y, whichever way I want to call it, or PMT by I by Y, PMT by I by Y. But in the book, they also mentioned about duration, which is specific to perpetual bond. The method which is there, which is 1 plus Y by Y, which is 1 plus yield by the yield. And this is a very special case of duration for perpetual bond, but I don't think you will be tested much on that. So this is just for your own understanding that for perpetual bond, there is a different technique. I don't think it has been tested extensively in the exam ever, but just, you need to remember that. The third is an effective duration technique or effective duration, which is saying that things are not actually true for an option free bond against an option embedded bond, because option embedded bonds curves have different kind of shapes and they're not truly like this kind of a shape. This is where they followed this formula BV minus minus BV plus divided by 2 times BV change in Y. So what is this BV minus? BV minus is if you decrease the yield by, let's say, if there is a 5 basis point change, then I'll say if I decrease the yield, BV minus means if I decrease the yield by 0.05% from its existing yield. BV plus means if I increase the yield to 0.05% if I increase the yield. So now think of it. When the yield decreases, the price increases. So in a way, when there is a BV minus or the shock is towards down, the BV, the book value price is going to be higher. In this case, the book value price is going to be, sorry, not book value, bond value price is going to be lower. Why is that? Yield बढ़ता है तो price कम होता है, right? प्राइस यील्ड घटता है तो प्राइस बढ़ता है, यील्ड घट रहा है तो प्राइस बढ़ रहा है. दैट इज वेयर बीवी माइनस इज द फर्स्ट फिगर माइनस बीवी जीरो. और ये कह रहे हैं इनिशियल प्राइस जो था ट्वाइस इनटू इनिशियल प्राइस इनटू द चेंज इन यील्ड. सो दिस इज द वन व्हिच वी आर which is basically tracking in a way kind of an average कि आपके पास एक स्ट्रेट लाइन है, एक आपके पास बॉन्ड प्राइस ये था, एक बार ऊपर गया एक बार नीचे गया, उसका एक सम टोटल निकाल दिया, उसका एक एवरेज टाइप निकालने की कोशिश कर रहा है या उसको उसका एक डिफरेंस निकाल के उसको एवरेज निकालने की कोशिश कर रहा है कि इन दोनों आंसर्स में कितना डिफरेंस है ऊपर वाले में और नीचे वाले में. This is what effectively he is trying to do. When it comes to convexity, the first method we have already discussed, T square W. The second method is modified convexity, wherein he's using convexity, whereas the other person was using macular duration by 1 plus m y by m की वजह 1 plus y by m whole square. The only difference here is this whole square. And ऊपर वाला numerator में convexity, and here it was mostly taken to be duration. So macular duration, the duration was here 1 plus y by m, convexity by 1 plus m 1 plus y by m whole square. That is the only difference which exists here. The third thing that he talks about is effective convexity, which is again meant only for mostly meant for the option embedded bond, can be used for straight bond as well, which is BV minus plus BV plus minus 2 times BV0, which is like ऊपर गया नीचे गया और 2 times उसका average निकाल लिया, divided by the initial bond value into the change in yield square. By how much are you thinking the yield will change is going to give you the effective convexity. So now with this kind of an approach, you'll never be able to forget what happens in entirety from the top down. If you just remember this chart, a few of these flow charts which are relevant for these particular fixed income universe chapters, you'll be able to get comprehensively a lot of knowledge on the fixed income, which is in your testable area. Okay, so now with this, let's move ahead uh, in terms of understanding this chapter. So the first is the dollar value basis point, which is we mentioned that is a change in the interest rate which is being tracked. It's a single factor approach. We will leave about single factor approach. The second approach that we have for duration is a DV01, wherein 1 basis point is being changed. 1 basis point. What is the percentage change in the dollar answers when your value changes by 1 basis point, which is 0.01%. Okay, now this is where we can refer to this formula. Now, ideally, I'll be giving you a few formulas here, but rather than using all different formulas which are done by the book, I'll give you one formula through which you can do a lot of these questions. Give me 1 second. Okay. So when it comes to duration, right? Specifically talking about duration, duration is equal to change in price, change in bond value, bond price. Let me call it bond price 1 upon duration is equal to 1 by bond price by change in bond price by the change in yield, right? This is what we call it as a modified duration formula, right? Now, if I talk about DV01, the only difference that I have to make is multiply both the sides. Multiply both the sides with, let's say, 0.0001. So I can talk about D multiplied by 0.0001, which is where we are talking about specifically one change in yield, is equal to 1 upon bond price into change in bond price by change in yield multiplied by 0.0001. Okay. So this is the formula which is meant for your DVBP. Why am I focusing on this? You'll see in some time. Now we go back to the question that we have for calculating this DV01. Let's say suppose the bond with the face value, which is the bond's initial price, is $10,000 with a coupon rate of 6%, semi-annually matures in 5 years. So it is 5 years maturity, semi-annual rate of 6%. The bond is currently priced at, sorry, this is bond is currently priced at this. So current bond price is this one. Suppose that there is a parallel shift in the interest rate change by 10 basis point and the bond price increases to this. So this is the new bond price. The new bond price is 101,181.44 and the old bond price is 107.50. And the change that has happened in this period is basically a 10 basis point shift. The term structure changes by 10 basis points. So the change in yield that has effectively happened is 10 basis point, which is 0.001, right? So now we refer to the formula for DV01, which says you have to multiply the normal formula, which is duration, multiplied by the bond price, which is the old bond price, which is there, which is 100,750, multiplied by 0.0001 is equal to, and this is where we are calculating it for. So minus D into this is going to be what we call it as DVBP. So I'm going to write this side as it is. Now on the left hand side, what was our formula here? 1 by BP. Yeah, I've already calculated 1 by BP is equal to the change in basis point by change in yield, change in bond price, which is 101,181.44 minus 100,750 by the change in yield, which is 0.001 multiplied by 0.0001. So effectively, we'll have to solve for this side. 43.144. And if we talk about DVBP, dollar value of a basis point, that is where to get the right number, you'll have to also multiply it with this one. 43.14 is your answer. And let's see what was our answer here. 43.144. Okay, so anything which is here, and let me write it this way so that you don't get confused. So dollar value basis point is essentially, I'll have to take this book value here multiplied by the bond price is equal to this. So now I can call this as DVBP. One way is I can write this as DVBP, or I can write this formula as DVBP formula as well. So one approach is because both approaches have been used. What is the formula for DVBP? That is duration multiplied by 0.0001 multiplied by the initial bond price. Or I can call it this way, that the change in bond price by the change in yield multiplied by 0.0001. Now, why am I focusing on this formula, not the formula from the book? Because this reading and the other reading, which is the next reading to this, will be following two different approaches for duration because they're written by different writers. They're written by different people, and both of them have a slightly different way of calculating for the yield. Having said that, when you understand this chapter here and you go to the next chapter, you will either not be able to get that chapter, or if you get that approach, you'll not be able to get this approach. So the essentially the same way of writing the same thing is DVBP can be calculated now with two ways. Either you have the duration bond price and then you multiply it with this, or you can calculate it with the change in bond price by the change in yield multiplied by 0.0001. Both will give you DVBP, right? This is a very, very important and testable point to be noted. Now, similar to DVBP, we also have a concept of, and when we talked about change in the bond price due to a change in yield by 0.001%, we call it yield-based DV01. But when we talk about change in bond price due to a change in the spot rate curve, 1 basis point spot rate curve. So think of it this way. I can write this information. What has been changing? Change in yield. When we talk about change in yield by 0.01%. When we talk about change in spot rate, again, parallel shift in the spot rate by 0.01%. Right? Here we're talking about yield. Change in zero rate, spot rate or a zero rate is what we are focusing on. And the third one is price and forward rate. Change in forward rate. Forward rate by 0.01%. Essentially, all three of them are talking about similar kind of a curve. We will call it yield-based DV01. We'll call this as DVDZ or TPDZ, TP dollar price. And this one is DPDF, DPDF or DVDF. And the most important is still this part, change in the yield curve, which we call it as yield-based DV01, which is where I'm trying to essentially understand if my yield goes up and down by just a little bit percent, by 0.01%, what is going to be the impact on this one, DV01, right? This is still the most important point. Now, this is the way through which we got to know that whenever the interest rate changes, the bond price do change. And when the bond price do change, they can go in either direction. If the bond price goes up, that means I'm making more money. If the bond price goes down, that means I'm having a loss. Now, it's important to protect for your losses, right? Whenever your worth of the asset that you hold that goes down, that means you're having a loss. It's important to hedge it as well. And that is where DV01 has been used for hedging as well, wherein you can connect this concept to the concept on hedging that was done in the FMP book, where you understand there was a hedge ratio first. And then the hedge ratio was finally used to find out number of contracts, number of future contracts that was required for hedging, number of future contracts that were required for hedging. So in this case also, the hedge ratio that you specifically talk about, which was in that case what was talked about was the hedge ratio in that case was the covariance, the correlation between the spot rate and the future price multiplied by, I'm just forgetting the formula. Anyways, the hedge ratio here is going to be DV01 dollar hedge ratio was DV01 for the bond for which you are doing the hedging, and DV01 for the future which is used for hedging this particular bond. DV01 for that is dollar value basis point for the, let me just take it away, dollar value basis point for the bond right now, position to be hedged by the dollar value basis point for the instrument which is used for hedging. For the instrument, we not call it future, for the instrument used for a hedging instrument, for the hedging instrument. I think in that case, the hedge ratio was correlation of standard deviation, correlation of S and F by standard deviation of S by standard deviation of F. This was the formula. Or we were also talking about covariance, where this was mentioned as covariance SF multiplied by standard deviation of S and standard deviation of F square. something of that sort. Not sure on this one, but this was definitely a formula. Correlation SF is equal to standard deviation of S by standard deviation of F. And it was there in the futures chapter. I remember that exactly. Hedging of futures, which is chapter number 4 or 5, if I remember it correctly. Right? Right. So this was the case of a hedge ratio, which helped us determine how many contracts we need to buy ultimately. Now, this position is not very, very different here. And then we used to take this hedge ratio, sorry, then we used to multiply this hedge ratio with, let's say, that was my portfolio value that I needed to hedge, and divided by the future value, which was used for hedging. The value of one future contract which we were using for hedging. The concept is not very different here in this case as well. Where we are saying once we have established what is the hedge ratio based on the duration. Now, okay, let me just talk about the example first, and then we can talk about the deficiency of this approach. Okay, so we have an investor has 1 million portfolio that needs to be hedged with a DV portfolio of 340. His duration value basis point, which is 0.001%, 0.01% change, means that his dollar price is going to be changed. Portfolio value is going to be changed by $340. The portfolio can be hedged with a 3% coupon 5-year bond. Now he's not using futures here. He is using another bond to hedge for this portfolio with a DVB if 285. The face value amount of this bond to the hedge ratio. So the hedge ratio of 340 by 285 first of all. Now with that being said, we ultimately use this hedge ratio to find out how many number of contracts that we need to buy if the value of one contract is given. Calculate the face amount of bond required to calculate for the initial position, which is multiplied by 340 multiplied by 285, 285 multiplied by 1 million, which gives us an answer this. Now we are saying we need to buy this worth of bond B to hedge our portfolio. This much worth of, we can determine this. So investors 1 million portfolio with DV01 of 340 can be hedged with one face value 3% 5-year coupon bond with DV01 DV01B of 285. So that's the point essentially we want to make. However, this whole approach of hedging with hedge ratio for fixed income security is slightly incorrect. Why slightly incorrect? Why not entirely, or why? I mean, it has a small deficiency there. You're calculating this hedge ratio with understanding of duration, right? For a small change in yield, everything works. But we said there is a higher change in yield, there is always a duration effect and a convexity effect that comes into picture. There's a duration and a convexity effect that comes into picture. While calculating for this hedge ratio, you're taking care of the duration part, but you're not taking care of the convexity part. Convexity part is missing. Convexity part is missing. So while you are talking about a hedging for an instrument which basically sees an interest rate change, which is very, very small, the strategy can work. But when it comes to the yield curves or the interest rate changes, which are of a higher amount, like 3%, say 5% interest rate change, okay, that is where the strategy might still be open, will still not lead to a good result. Now we come to the concept of duration and computing duration, computing convexity in its entirety. Okay, so now we are going to start with duration and convexity as a concept. So duration के लिए we have referred to this particular diagram. Yeah. With that, let's solve for one of the questions. So effective duration. Okay, let's start with the direct question. Suppose a 15-year bond. Let me take this. Suppose a 15-year bond with the annual coupon of 7% is currently trading at 98,550. The bond has a duration of 3.28. Compute and interpret the bond's duration for a 25 basis point decrease in all rate. That means the basis point decrease or the change in yield you're planning to have is 25 basis point, 2.5%. Or I can write it 0.0025. With that being said, the formula for duration is duration into bond price is equal to change in bond price by change in yield. So the change in yield is 0.0025. What is the change in bond price that I can expect if the duration given is 3.28 multiplied by bond price 98550 multiplied by change in yield or rather I should say 3.28 minus into 98550 into 0.0025 is equal to the change in the bond price. Now, of course, we know that if the duration is decrease in uh, decrease in yield, it's going to increase the bond price. So first of all, whatever my answer is, I'm going to say it is going to be an increase. Now, this is the answer that's been given with the multiplication. So I would definitely say that this is the price increase. 801.811 is expected to increase by $808.11. Okay, so let's go to our next question. Callable and puttable bonds. As we now know, callable and puttable bonds have a different way, and that is where the important point to note here is that there is an effective duration way to calculate for both. Um, so now we also want to understand whether a bond will be called or not. So as we understand for a, let's say, callable bond. Now, callable bond operates in a way that this is the usual curve. This is the callable bond. So let me remove the diagram from here. Let me remove it here. So the ultimate diagram that I have is a curve like this, right? Till about here, till about at this range, the bond can be called. And around this range, the bond will not be called. Bond will not be called. That means it will behave like a normal bond in this range. It will behave like a normal bond in this range. It will behave like a normal bond, but it will behave strangely here. It will behave strangely in the portion which is this green highlighted portion here. Okay, so that is where it says that there is a probability, the effective duration, or if I can say the expected duration. If you remember quants, then if I want to call out the expected duration, that can also be found out by finding out what is the duration till this point and what is the duration afterwards. So then we can say that the weighted duration or effective duration is the called part and the not called part. The called part and the not called part, right? The called part and the not called part. In that term itself, I'll give you another concept which looks very, very similar here, right? All we talked about is the duration and convexity related to a single bond. Let's assume all my wealth is now in bonds. I have bonds of all type in my portfolio. Bonds and portfolio. So I have a portfolio which consists of bonds. Now, naturally, there are few bonds. Let's say the duration of one bond is 5, duration of next bond is 3, duration of other bond is 2, so on and so forth. And I'll have multiple bonds. So how can I, and I know that if my complete portfolio is made out of bond, it will again be moved by duration and convexity. So the point here is how much of my portfolio is going to change. Now remember, now I'm not talking about the change in a single security. Now I'm talking about the change in the portfolio which consists throughout of the fixed income security. So now I'm not talking about single security. That means the concept of duration convexity that we studied on a single security level is also valid here where we talk about duration and convexity, right? Now we call this portfolio duration and portfolio convexity. Portfolio duration and portfolio convexity. The point here is because we know the same change, the same macroeconomic change in the interest rate over which we have no control is going to impact us in some way. So how do we calculate it for portfolio duration and portfolio convexity? The answer is very, very same and solid for both. Take a weighted average of duration or convexity of individual security in a portfolio of individual securities in a portfolio. Securities in a portfolio. So what do I mean by that? What do I mean by that? Let's say I have two bonds with me. Let's say I have a bond A and bond B. Bond A is 70% of my portfolio. Bond B is 30% of my portfolio wealth, right? In a way, I can say $70,000 invested here, $30,000 invested here out of 1 lakh portfolio that I have. Now, let's say the duration of this bond is 5, duration of this bond is 3, and the convexity that I have with it is, let's say 4 and 2. Okay, or let's say 40 and 20. Now let's look at this. If I were to calculate the duration and the portfolio duration, so I'll call it portfolio duration to be 70% of, like 0.7% of 5 and 0.3% of 3, which is zero point 0.9 and 3.5, sorry. Effectively 4.4 is the duration that I'm talking about. In a similar way, if I were to take a portfolio convexity, my answer would look like zero point 0.7 of convexity 40 plus zero point 0.3 of convexity 20, which is zero point 0.6, and this is 2.8, giving us an answer 3.4 is the overall convexity of a portfolio. So in a way, what I'm moving the discussion towards is from purely like a security standpoint to a portfolio that consists all throughout of the fixed income securities here. Okay. So this concept of portfolio duration, portfolio convexity is also is discussed here in the later part of the book, but it's not very different. So if you want to solve for this example, let's look at this example. I'll not be solving it completely, but of course I'll be explaining this. Okay, there are 3 bonds in a portfolio, let's say, and the portfolio weightings and individual duration and convexity has been given here. So the weighting is 2%, 3.5, and 4. And this is the weight that's been given. So 2 by 10, 2 by 10, 3.5 by 10, and 4.5 by 10 is the weighting, right? 2 by 10, 3.5 by 10, and 4.5 by 10 is the weighting, right? If I want to calculate it for the portfolio duration, I'll have to multiply 2 by 10 with 4.02, 3.5 by 10 to 9.36, plus 4.5 by 10 to 13.75, giving me a final answer of 10.36, which is considered my portfolio duration. In a similar way, we can also talk about convexity, where 2 by 10 is multiplied by 14.05, plus 3 by 10 multiplied by 71.80, plus 4.5 by 10 divided by or multiplied by 170.29, and we get our answer 104.57, which is now the portfolio convexity. Okay, now having said that, let's move back to the areas that we haven't touched upon. DV01 and duration are same concept, except for the fact when you talk about duration, you don't attach any percentage change. So if it's 1% yield, 10% yield, or whatsoever, you just talk about a change in generic. When we talk about DV01, you are specifically talking about 1 basis point, right? So that's where it says when duration is calculated because you take that change in yield in a denominator, you're looking at like 1%. And DV01 is I'm looking at 1 basis point or 0.01 of a percentage. And then we switch over to the concept of convexity, where we already have this kind of a formula with us, and how we use it is mentioned here in the next example. So let's look at the example itself. So this is about convexity example. Now, suppose there is a 15-year option-free non-callable bond. That means it's a straight bond with annual coupon rate of 7% trading at par, 7% coupon rate. If the interest rate rises by 50 basis points, this is the kind of shock we are inducing. The estimated bond price is 95. So if it is interest rate rises, that means the bond price increase, then the yield decrease, and that is where the price is 95.586. And when the bond price decrease, the price increase, that is where we have 104.701. So all I do is here in the formula BP minus BP, sorry, BP minus BP plus minus, sorry, plus is here, and 2 times BP by BP into change in yield square. So all I have is 104.701 plus 95.586 minus, now nothing has been given, so I'll take this value to be 100, means the par value, change into change in yield, which is 0.005 square, 0.005 square. And once we solve for it, we get an answer which is 114.8. Now the total thing, the total convexity for this figure is 114.8. If I have to actually use it, how would I use for the convexity effect? I'll use it half multiplied by convexity multiplied by bond price multiplied by change in yield square is this I would use. So this ultimately 114.8 is a thing which is going to be used here if I have to calculate for the overall convexity effect. If I have to check for the overall convexity effect. Okay. So it is a sum total of duration effect and convexity effect. The next question, in fact, talks about both the things in parallel. So let's look at this example wherein they're using duration and convexity. As I said earlier, the information on duration and convexity might be represented in a different way, but the overall tree structure tells you that there are three effective ways of duration, three ways of duration and three ways of convexity, the pure convexity. So using the duration convexity approach, use the effect of 150 basis point increase and decrease on a 15-year 7% option free bond currently trading at par. Duration is this, convexity is this. So how should I use it? So the change in price is going to be minus D into what? The bond price multiplied by the change in yield plus half of convexity into change in yield square into bond price. So in a way, I can take the bond price constant. Okay. So minus duration, duration is given to be 9115 minus 9.115 into 100 into change in yield, which is 0.015. This is the overall duration effect plus half of convexity, which is 114.8 multiplied by 0.015 whole square multiplied by 100. And if I solve for this, exactly the same thing, I'm just rechecking if everything is same in calculation, then I should get my answer, which is equal to minus 12.381. Now, an important point to note here is that what is the change in the bond price here? The effect of a 150 basis point increase. Now, if the yield is increasing, the bond price will decrease, and that is what we want to conclude, that 12.381 would be the decline in price. So using the duration loan would have implied a price change of 13.6725, which is more decrease, right? That is a bond price decline of this much. In other words, duration would have overestimated the decline. It would have overestimated the decline. What we are saying is there is an underestimation of decline. Okay. Then we come to the duration and portfolio convexity, which we have just covered. Then we talk about hedging. 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 Now we have talked about portfolios also. Now we talk about portfolio hedging and how do we do it. So when it comes to portfolio hedging, let's look at the example. First of all, what do you hedge? You hedge for your downfall movements, right? That means whenever there is a loss, you try to protect for your losses. So you should understand when are you having that kind of a downfall movement. Okay. So now an investor has 1.7 million invest. Let's look at this example. Okay, they have given two examples here. Let's look at the first one. An investor has 1.7 million investment with a duration of 6.5. So the portfolio value is 1.7 million, duration for a portfolio 6.5. Investor is looking to hedge the investment using a bond with a duration of 7.9. So the duration of a bond used for hedging is 7.9. Calculate the face value of bond required for the investor's position to hedge, demonstrate the result. So of course, 6.5 is the duration for the instrument, it is, and 7.9 is for the instrument used for hedging multiplied by 1.7 million, and you will get your answer. This is the hedge ratio where this is the hedge ratio, right? And that's how you'll get to know the results. Okay. So now you will have, like, you can determine the phase using the required hedge position with the minus bond value. Why is he taken a minus bond value? Because, to hedge the bond, you can't add a bond because both of them will be susceptible to interest rate. You'll have to, because you're hedging a bond with a bond. right? A bond with a bond is a positive correlation. A bond with a bond is not a negative correlation. So if you're long on one bond, if you already have this as a long position, you'll have to hedge it by whatever you're using as a hedging instrument. You'll have to short, and especially if it's a bond. So short the bond for hedging. Short the bond for hedging. This bond that you want, he's talking about for hedging, he'll have to short it. The investor should therefore short 1.4 million worth of bonds. The portfolio is fully hedged and parallel changes are reflected here, right? So now he's changing what is the change in the value is. If it goes 6.5 multiplied by 1.7 multiplied by change in Y, he gets a loss of this much. But because he also has this other hedging instrument, he's making enough gain. In a way, neutralized position. In a way, neutralized position. Right. The next thing talks about the usage of not a single bond. Here he was using a single bond. Here he was using a single bond, and the discussion was all towards the interest rate sensitivity coming out of the duration only. It has nothing to do with convexity. The next example takes a step further in that. He talks about duration of a convexity um, as well as for a convexity and as well as for a duration. Okay, so now we take a look at this next example, which is going to be more complex. Okay, and in this case, I'll refer to the other book. The same example was referred in the other book in 2020-22 version, I guess, with a different thing. So let me go back to that. I'll take the same example out. Yeah, this one. So look at this example, and I would urge if you guys solve it from here. The investor has 3 million because the reason is they've not explained it so very well. But the other book in 2023 version, 2022 version was explaining this example in a better way. So let me take this example here. Same example solved differently. Okay, right? So now he says an investor has 3 million investment with the duration of 6 and a convexity of 25. So his portfolio is that of 3 million worth, whereas duration is 6 and the convexity is 25 right now. The investor is looking to hedge the instrument using two bonds. There is a bond 1 and bond 2. The bond 1 that he wants to have has a duration of 7 and a convexity of 20, whereas bond 2 has a duration of 5 and a convexity of 19, right? Now remember, whenever you add your portfolios, you want to hedge for your portfolio's duration with the duration of the hedged instrument. So think of it this way. I am trying to hedge for the portfolio duration, which is actually 3 into 3 million multiplied by 6. 3 million multiplied by 6 million by adding a portfolio, which is plus plus the duration of 6, the duration of 7 for bond 1. Let me call it bond A. I'll call it A, and this I'll call it B, minus 20 B, and the overall exposure should be 0. So minus 6 minus 7 P1 and 5 times, sorry, this is 5, this is not convexity, 5 times P2. Or let me call it out in a different way so that things are more clear. I'll say 3 into 6 plus minus 7 times duration of A bond plus, because this was the duration, or rather I should say what quantity should be added now. I'll just not do it right. Give me 1 second. So this is one equation. The other equation I want to match is that of a convexity. So I say the convexity is 25. So 25 is the convexity for a 6 million worth of portfolio, which I want to hedge it because the convexity is always positive. I'll use plus 20 times A plus 19 times B is equal to 0, right? So minus, so of course, this is also minus because this is duration. So minus 6, in fact, this should be minus 6 here. So minus 6 multiplied by 3 minus 7A minus 5b should be equal to 0, and 25 into 6, now 25 into 3 rather, it's a 3 million portfolio. 25 into 3 plus 20a plus 20a plus 19b should be equal to 0. By solving this, you'll get a and b, which is going to be the quantity that you should own. Quantity of bond A is going to be 1. In this example, it is 1. This example is this is minus 5. So he says go long bond 1 by 1 security, go short bond 2 by 5. So the investor can hedge therefore the 3 million investment with 1 million long position in bond 1 and 5 million short position in bond 2. This ensures that the investment will be hedged again even the larger parallel change. Okay. This is what he mean by long and short example here. Now, if you look at this example here, this has been solved very differently. They've directly given you solving this, solving P1 and P2, we get this. Now they've taken away that step. The investor can therefore hedge a 3 million investment with a 1 million long position in bond A and 5 million short position in bond 2. This ensures that the investment will be hedged even for a larger parallel changes in rate. So the point here is larger. The earlier calculation was based out of only duration and was no longer talking about anything to do with convexity. This one is different because it talks about duration and convexity. So we say that the portfolio duration should match the duration of the new hedged instrument, and portfolio convexity should match the duration of the, the portfolio convexity with the two to be hedged kind of bonds like bond A and bond B here. So this is where it stands. Now let's go to the next example of constructing a barbell portfolio. Constructing a barbell portfolio. Now what happens in case of a barbell investments? So there are basically two types of investment. One is called as a bullet investment, another is called as a barbell investment. Now both are based out of the fact that there are times for the securities to mature. So time is on this end, right? Time is on this end, and then weightage of securities here, weightage of security is on the y-axis, weightage. Now, sometimes you put majority of portfolio here and here with less being here. So you'll have more weight here, more weight on the extreme ends, lower end and higher tenure or higher maturity. You'll keep most of your portfolio, and here it would be lower. Whereas another case, what you will have is a case like this, where you'll keep most of your investment in the intermediate time with low investments being here or here, low or no investments in fact being here and here. So we call this kind of portfolio as something which is called as bullet because they're more sharp. In the intermediate range, let's say if I'm parking all my investments in a 10-year bond, I'll call this as a bullet. But if I'm parking most of my investment in, let's say, a 2-year bond and then a 15-year bond, and then keeping a lowest investment into, let's say, 10-year bond, this is what I'll call it as a barbell. Barbell. Okay, so there is a bullet portfolio and a barbell portfolio. Now the point of this being that when you talk, because when it comes to portfolio, it boils down to essentially the portfolio duration and portfolio convexity. So I'm saying there could be a chance that portfolio convexity, sorry, portfolio duration for barbell portfolio might be equal to portfolio duration for bullet. But the point here being the portfolio convexity for barbell is not going to be the same as portfolio convexity for bullet. And that is the point he wants to make, that you can have your portfolio built out in any way to match the duration, but to match the convexity, it's not possible by allocating it like this. Is typically used when an investor invests in bonds with a short and a long-term maturity, thus foregoing any intermediate term bonds. And the bullet is when investor buys a single bond, typically concerned with the intermediate maturity range. Some books also define this diagram as this, like bullet is here with zero investment here, Sorry, this is barbell and bullet may be represented like this. Every investment into only one security. It depends on what kind of, I've used line graph, they can use chart as well. Now, if you do the matching, if you want to do the matching, what you should do is basically, you know how to get up with the combined convexity. Now, the point is very, very simple. How should you should split your portfolio if you want to match for the duration convexity or duration. Like, let's say the duration of this bullet portfolio, which has only one security investment, is 140. Duration for bullet, right, is 140. No, not 140. Sorry, 140 is too high. Let's say the duration for this is 7 years, right? Now, I want to invest into two different securities which should match up to this duration, right? But the duration that I have, and I just have one duration, bonds duration is 5 years, another is 10 years. So let's say one duration is 5 year, another is 10 year. Now I want to give it an appropriate weight. So one weight would be weight of this security, another would be one minus the weight of other security. So this, by doing this, what I get is 5 weight plus 7 minus 7 weight is equal to 7, which is, sorry, I should give it a more weight. Let's say 9 years. Let's say 9. Okay. So then I have 9 weight minus. So this is minus 4 weight. And this is 7 minus 9 is minus 2, which is weight of effectively 50%. So I'm saying by constructing my portfolio in such a way where I allocate, 50% of my portfolio in a bond which has a duration of 5 year and a bond which has a duration of 9 year. So I'm investing 50% each. I will have the same kind of duration as I will get by investing 100% of my wealth in a 7 year bond. 100%. So this is duration. Right now I'm talking years in terms of duration. Okay. Similarly, I can match it up for convexity also. Similarly, I can match it up for convexity also. So if I have been given a convexity, I can combine for this portfolio and come up with a convexity number. Okay. With this, we have completed this chapter as well.